You can have one or both. You can have cheap homes, expensive rates, or you can have low rates, expensive homes. You can't have both. Lending in the that was the other thing. Yeah, lending in the commercial real estate market right now is kind of getting fucked up.
What are you seeing?
So I actually got feedback from the group of lenders that I usually work with, big lenders too. Like they do billions of dollars. Yeah. They do like billions of dollars a year, like hundreds of hundreds of billions of dollars a year in lending, and they're just like, man, because the markets are so volatile right now, lenders are really, really tightening up, like really tightening up, and becoming very, very, very hesitant to lend out funds right now, which is really shit and also really scary.
Yeah. So, what would be the things that are making it, or like, how do they essentially tighten it up? Is it just essentially like a higher stress test, or like what else is going on?
I haven't even gotten that far, but it's kind of really shit because we're trying to build Coachwood Capital with this, right? And what I'm seeing is although cap rates are coming down, they're not coming down enough to get the returns that we would want based on the interest rates that we're getting quoted. That's the fucking big problem right now. And I don't think it's actually going to come down. I think people will hold onto their properties, and rightfully so, because rent is really going up right now because the affordability index of real estate or even buying a principal residence it doesn't work. It's what people think. What people think is happening right now is because houses are coming, or residential homes are coming down in value. They think that like a lot of people can afford housing now, but that's not the case. You can't have cheap housing and cheap rates. You can't do those. You can't have both. You can have one or both. You can have cheap homes, expensive rates, or you can have low rates, expensive homes. You can't have both. So what we're seeing right now, though, is people. It's almost like people are so used to seeing that value of what they owned, or whatever they've been sitting on. They're used to that 20% increase in value. They don't want to come down. They don't want to come down. And I have the exact same mentality where I know the market's going to go back. Like anybody can look on a 100-year curve of what's real estate's done. It could tank. It could tank like it did in 2008, which again, I went through all 2008 too. I'm not scared of what's going on right now. It could do that and it'll come right back, right? So I think that's the mentality that people are having right now where, okay, I'll sell, but you're not going to get a fire sale. I'll come down a little bit on cap because I understand what's going on in the market, but I'm not going to come down to like double-digit cap rates to justify you getting the return that you want because the interest rates are going up so much. It's not happening. And the banks, what I am seeing, the loan to value is not like, it's hard to get 75-25 right now. Very hard. We're looking more like at like a 65-70 at this point. Debt service coverage ratio is starting to creep up a little bit, obviously, because why? Rates are going up.
Yep, cost of debt.
Yep, cost of debt. And the big problem with that is you're being restricted by debt service coverage ratio now, where you can't even get a decent, LTV. And I consider a decent LTV at 75-25. That to me is a good LTV. Yeah. Right? You start getting up to 80, you start getting up to 80-20 LTV. You're starting to push limits a little bit. The banks don't really like that because you don't have enough skin in the game, shit like that. You start getting lower than 25, 75-25. Your returns start to, not struggle, but they start to, get a little bit lower. I like that. I like the 75-25 LTV. That's the target that I like to have. But the way that the rates are going right now, that's hard. That's getting hard. You're getting restricted by debt service coverage ratio now because of the rates.
So to adapt to what's going on with what you're seeing, what's your idea?
To be honest with you, it's actually the same. That it's just never changed. Just simply buy good property in great locations, that cash flow even still, And my argument with this is, no matter which other investment that I look at, what the fuck are the other options? Like, seriously, what are the other options? I sent you a text message on the weekend saying, hey, what do you think about offering a debt fund?
That's what I was referring to.
Right?
Yeah.
So what I am seeing, because of rates now creeping up so high, I am seeing private lending getting higher. The rates on private lending getting higher, and I'm doing a few now, smaller ones. Again, first position, decent LTV from the borrower, but you got to still be careful, because although I don't think the market's gonna go down much more than it is, I don't have a fucking crystal ball. So when you're lending money, and that guy has, say an 80-20 LTV, because a lot of these guys, they won't come down like. I usually see a higher LTV in the private debt world. So if you don't have enough room to play with, and you get caught with another 20% decrease, and you go to sell that property, you might get hurt a little bit.
Yeah.
But at the same time, what are the other options? What are you going to do? Put it in the stock market right now? Holy fuck. Right? Like, so are you going to do that? Are you going to go, what else are you going to do? There's not a whole lot of options right now where you can still actually get the return on real estate versus like other investments, because you can still get a good return comparatively speaking. And right now, rents are going up like considerably because of the affordability of residential homes. A lot of people can't afford it. Like my senior property over in Canton, Michigan, it's going up in rent considerably because people can't afford homes in the area right now, even though homes have come down in price, not crazy, but slightly. Even though homes have come down in price, they still can't afford it because, rates are, 6-7%.
Yeah. They
can't do it. They can't afford it. So they got to live somewhere, right? All these people are being pushed out of home ownership. Well, they're going to rent. So that's my justification. I would really, I like to stay within those two investment vehicles: private mortgages backed by real estate, and real estate. And specifically during a time like this, very stable, stabilized real estate with a very stable tenant base, which I like, again, senior communities.
So if you were to open up some sort of debt fund like that you just mentioned for that first option, what would be the options for investors to get involved?
Right now, a lot of people like to do multiple different types of funds. A lot of people like to do, that I've seen, first position mortgages, second position, and then maybe like almost kind of like a VC fund where you're kind of your venture capital fund where you're kind of funding new businesses or whatever. I don't really like that. Obviously, right now it's really not the time for that.
Yeah.
I don't like the second mortgage right now. I would really only do first position mortgages, probably in and around 12 to 15%. And I would for sure, you'd have to come in as a borrower at 80-20 LTV. Those would be my requirements. So I'm actually thinking about getting people, our clients right now. I think what would be an interesting play with Coachwood Capital, and I've been really playing this over in my mind. It takes some time to get a property. Well, what do you do in the meantime of that property? Why don't we pool together funds and put a debt fund together? And the reason why we could put a debt fund together is we can constantly just put debt. We could pile debt into this fund and have people come in whenever, right? And if there's not enough room for you to come in, you just give us your money. We'll go out, get mortgages, because I do have a pipeline of private mortgages, and we'll simply we'll fund it with your money sitting there. What are you going to get right now?
Yeah.
What are you going to get? Like, what are you going to do right now? It's awful, the kind of return. So if people don't mind allowing us to sit on your funds, I don't mind that. Unfortunately, the Ontario Securities Exchange doesn't allow me to fund the debt first and then move it over. So I'm going to figure out a way how I can actually do that. The litigator from Toronto that I work with, he specializes in securities.
Yep.
So I'm going to figure out like how I can actually do something along those lines where we can get a debt fund going, and I could take down the debt first, but then I can accept people's money and then just repay them based off of it. You know what I'm saying? Yeah. I wonder if that's something that we can do. But yeah, I mean, we have a pipeline of people that want to, get better returns than what they're getting, wherever they are getting, and hedging against. I mean, inflation is still around, 6 to 8% or whatever it is right now. It's not coming down as fast as people think, and it rightfully so it wouldn't. So what are they going to do with their money? You might as well get you have to hedge it against inflation, and if you're not getting over, call it 8%, then you're losing money.
Yeah.
So what are you going to do with it? Even you throw it in a hedge fund for what, 4%? Like, where are you going to put it? There's no other options.